This question tests knowledge of bond indentures and the protective provisions included to safeguard creditors. A bond indenture is a legal contract between the bond issuer and bondholders that outlines the rights, obligations, and restrictions applicable to both parties. One of its primary purposes is to reduce the risk that management will take actions that could weaken the company's ability to repay its debt. The question describes a clause that prohibits a company from acquiring or disposing of major assets without obtaining creditor approval. Such restrictions are designed to protect bondholders by preventing significant changes to the company's asset base or financial position that could increase default risk. Students should recognize that these restrictions are protective covenants, which may be either affirmative, requiring certain actions, or negative, restricting certain actions. The described clause is a negative covenant because it limits management's freedom to make major asset transactions. Choice analysis. A. Protective covenant, correct. Protective covenants are provisions in a bond indenture that protect creditors by restricting or requiring certain corporate actions. Restricting the sale or acquisition of major assets without creditor approval is a common example. B. Call provision, incorrect. A call provision allows the issuer to redeem bonds before maturity. It does not restrict asset transactions. C. Warrant, incorrect. A warrant gives investors the right to purchase the issuer's stock at a specified price. It is unrelated to creditor protection clauses. D. Put option, incorrect. A put option on a bond gives the bondholder the right to sell the bond back to the issuer under specified conditions, not to control corporate asset sales. Correct answer. A. Protective covenant. Exam tip. Protective covenants are designed to safeguard lenders by limiting actions that could increase credit risk, such as excessive borrowing, large dividend payments, or major asset sales. In contrast, call provisions, warrants, and put options are financial features that provide specific rights to issuers or investors rather than operating restrictions on the issuing company. This question tests understanding of mortgage bond indentures and the protective covenants included to safeguard bondholders. A mortgage bond is secured by specific assets, such as land, buildings, or manufacturing facilities. Because these assets serve as collateral, the bond indenture typically contains restrictions designed to preserve their value and protect creditors. Students should recognize that indentures often include both affirmative covenants, requiring the issuer to take certain actions, and negative covenants, restricting certain activities. Common provisions include maintaining the pledged property, keeping it adequately insured, restricting its sale without trustee approval, and limiting the creation of additional liens through a negative pledge clause. The question asks which of the listed provisions are likely to appear in the indenture of a mortgage bond. Since all four provisions help preserve the value of the collateral and protect bondholders, each is consistent with standard mortgage bond agreements. Choice analysis. I. Receiving the trustee's permission prior to selling the property, correct. Because the property serves as collateral, the issuer generally cannot sell it without trustee or creditor approval. 2. Maintain the property in good operating condition, correct. An affirmative covenant often requires the issuer to properly maintain pledged assets to preserve their value. 3. Ensuring plant and equipment at certain minimum levels, correct. Indentures commonly require adequate insurance coverage to protect the collateral against loss or damage. 4. Including a negative pledge clause, correct. A negative pledge clause prevents the issuer from granting additional security interests that would weaken existing bondholders' claims. Since all four statements are appropriate indenture provisions, the correct choice includes every item. Correct answer, D. 1, 2, 3, and 4. Exam tip. Mortgage bond indentures focus on protecting the collateral securing the debt. Typical covenants require maintenance, insurance, restrictions on asset sales, and limitations on additional pledges of assets, all of which reduce the risk faced by bondholders. This question examines the factors influencing a company's capital structure decision, specifically whether to raise funds through debt or equity financing. The key concept is that companies compare the costs and benefits of debt and equity before issuing new capital. One major advantage of debt financing is the tax deductibility of interest expense. Because interest payments reduce taxable income, companies with higher effective tax rates receive a larger tax shield, lowering the after-tax cost of borrowing. Consequently, firms facing high tax rates often have a stronger incentive to issue debt rather than equity. Students should also recognize situations where debt financing becomes less attractive. High operating leverage, extensive existing lease obligations, or weak ability to cover fixed charges all increase financial risk and make additional borrowing less desirable. Choice analysis. A. High break-even point, incorrect. A high break-even point indicates substantial fixed operating costs and high operating leverage. Adding more debt would increase total risk, making equity financing more attractive. B. Significant percentage of assets under finance lease, incorrect. Finance leases create fixed payment obligations similar to debt. A company with substantial lease commitments may avoid issuing additional debt because its financial leverage is already high. C. Low fixed charge coverage, incorrect. A low fixed charge coverage ratio indicates limited ability to meet interest and lease payments. Additional borrowing would increase default risk and is generally discouraged. D. High effective tax rate, correct. Interest on debt is generally tax deductible. A company with a high effective tax rate benefits more from the interest tax shield, reducing the after-tax cost of debt and making debt financing relatively more attractive than equity financing. Correct answer. D. High effective tax rate. Exam tip. When comparing debt versus equity financing, remember that the tax shield on interest expense is a major advantage of debt. Companies with high taxable income and strong debt servicing capacity are more likely to favor debt financing, while firms with high financial risk or weak coverage ratios often prefer issuing equity. This question tests knowledge of long-term debt instruments used in corporate finance. Debt instruments can be classified by their maturity, security, and financing purpose. The key phrase in the question is generally has a maturity of 10 years or more. In financial markets, bonds are long-term debt securities that usually mature in 10 years or longer, although some may have shorter terms. They are commonly issued by corporations and governments to raise long-term capital and typically pay periodic interest coupons. Students should distinguish bonds from notes, which generally have medium-term maturities, often ranging from 1 to 10 years. Likewise, a chattel mortgage is a secured loan using movable personal property as collateral, while a financial lease is a leasing arrangement rather than a debt security issued to investors. The question requires identifying the instrument most commonly associated with long-term borrowing exceeding 10 years. Choice analysis. A. A bond, correct. Bonds are long-term debt instruments that generally have maturities of 10 years or more. They are widely used by corporations and governments to finance long-term investments and expansion. B. A note, incorrect. Notes are debt instruments with shorter or intermediate maturities, typically ranging from 1 to 10 years. They are not generally classified as long-term instruments exceeding 10 years. C. A chattel mortgage, incorrect. A chattel mortgage is a secured loan backed by movable assets, such as vehicles or equipment. It is a financing arrangement rather than a marketable long-term debt security. D. A financial lease, incorrect. A financial lease is a contractual leasing agreement that provides financing for asset use, but is not a debt instrument issued in capital markets. Correct answer. A. A bond. Exam tip. A simple way to remember debt classifications is commercial paper equals short-term, less than 1 year. Notes equals medium-term, 1 to 10 years. And bonds equals long-term, generally 10 years or more. This maturity distinction is frequently tested in finance and accounting examinations.